Welcome to another episode of the Chris and Lisa Show. Today I'm here with Chris Heeman. He is a discretionary portfolio manager. He's been in the industry since 1993. He's a wizard at all things investing. And today we're going to continue on our conversation around behavioral investing and behavioral finance. So today we're going to talk about money biases, investing biases, and basically what's happening in the market right now. And I think, Chris, I'm going to ask you to give us some real life examples about some of the biases we have toward investing.
Hi, Lisa. Yeah, great idea. After talking last week, I think that would be fun today to kind of take two, maybe three, even if we can get to four current biases that are in the market today that we could see and talk about as a real life example. How we're behaving today, depending on the information we have. I thought we'd just do that, go through four good examples and talk about the reality here of what's happening.
That sounds great.
I've got a little cartoon to illustrate each one of the biases that we can have. So let me just share my screen here so we can pull this up. And we'll start with this one. Now, I don't know if you remember this little guy. He's one of my favorite cartoon characters. Okay.
Oh, yes.
Calvin.
Calvin, yes.
Calvin and Hobbes. Did you ever read this when you were
a little bit, younger? But yeah, no.
There we go. Okay. So Calvin and Hobbes was my favorite cartoon. So a little backstory. The guy that created Calvin and Hobbes, there were two great philosophers, John Calvin and Thomas Hobbes, and he created these two characters. You know, Calvin, the little boy, and his tiger, and this is little Susie, the girl next door that he's always trying to hit with water balloons, right? So in the cartoons, there's a lot of philosophy and biases, cognitive things, the things that make the storyline funny, and I steal from it all the time, because like this one where he's throwing the water balloon or the snowball, sorry, not the water balloon, but he's got this snowball and he's tried to hit Susie with it, and he says he missed and all the miserable luck, and there must have been a cross breeze. I can't believe I saved this snowball for 3 months. This is very typical of what we call a self-attribution bias. Okay, a self-serving. All have that when things work out the way that we hope that they would work out, we have a tendency to downplay really how much luck has come to play. Luck is always in play. You know, what skill does, I heard a great quote, is that the higher skill is to give luck a better chance. Okay. So what this attribution has, this bias right now in the marketplace, is there is a lot of success if you have been a retail investor, and after the March sell-off and how things happened, people can connect their successes to how much skill they have from an investment point of view, and they may not understand what really is happening. Okay. I always tell this story about minor sports with my kids, because when you're successful, when you're young, there's this idea that you can attribute all of this talent and skill, and that's going to be there and continue to be there forever. Okay. I have a young son who happens to be on in a May birthday, and he has he's pretty talented, but when he makes the top teams, one of the conversations we like to have is we want to make sure we understand why are we successful. And part of the reason we're successful is ourselves. But there's something else underlying our success sometimes that we should attribute to, or we should be honest about. And so what I've been trying to teach him is, as an 11-year-old, is you're the size of a 13-year-old. So if you're a big kid you're going to have certain skills. Size is a skill until it's not when you play sports. And what I was hoping to help him with is to get this bias understood, that where are the things and what are the things that are helping us be successful that we might not understand are actually in play? Is it truly us? Or are there things like you were born in May, and so when you play certain sports, you're one of the bigger kids, and being one of the bigger kids means that you are more successful right now until you get to be about 18, and then everybody's big. So those kind of self-serving biases are there all the time. And as our little cartoon example is that Calvin does not attribute hitting the girl with the snowball to himself, but he attributes to all sorts of other environmental factors. And that's a self-serving bias in motion there. And it's happening right now. A lot of people have been successful. They've bought things in the investment market, maybe not quite understanding what's making it successful. Okay. And not diving deep enough to understand. So that's one of the first biases that we can run into that's happening right now. Any questions on that?
No, that's great though. Great comment.
Okay. Yeah. So let's staying with my Calvin and Hobbes theme. Let's take a look at another cartoon here with Calvin. And we'll see if we can give a good illustration on this one. Let's see here. Okay, that should be up. So here he is again, throws his little balloon up in the air, and then when it lands, the water balloon, sploosh, explodes all over him, right? Which Calvin says, how can something seem so plausible at the time and so idiotic in retrospect, right? So this is one of those things that we have as hindsight bias, right? What we think, and then we actually go through, and what actually occurs, we can have a divergence. This is what I'm thinking is going to happen, and then it doesn't. Something else happens, and you kind of look back and you say, well, that makes more sense, and hindsight is 20/20, right? People have a tendency to look back, and because you know the outcome, you're biased because you don't know what's going to happen when you first made that decision. When you finally get the outcome, that's when you get a chance to compare what were you thinking, what were you hoping. There's a great book out that I recommend to a lot of people. I think I mentioned it to you, is that there's a book by Annie Duke, who was a champion World Series of poker player, and she wrote a book called Thinking in Bets. It's a fantastic book on decision-making processes and how we get caught in these biases. And she uses poker as a lot of her story base to help people understand what's happening. And Annie talks about doing consulting and how she goes in and she talks to big executive committees and people that are running big corporations, and she will ask them about their decision-making process. Where did your decision-making process, give me an example where your decision-making process didn't work. And so what she hears a lot, what she says is, I hear a lot of people telling me about the results. The results were bad. But when she focuses back on the decision process of why you made those decisions, right? They're not that bad. But we have a tendency to correlate or to connect the way we make decisions and the outcomes versus taking a look at the objective data and saying, well, what outcome were you expecting? And if it didn't happen, should you be changing your decision-making process? Connecting our results directly to our decision means that when the result isn't what we want, we have a tendency to change our process getting there. But sometimes, realistically, there's an outcome that was factored that maybe luck. Maybe it was just bad luck. Okay? In poker, there's a probability bet of cards that you're playing will win. So if you have cards that have an 85% chance to win, that's not a 100% chance. Okay? You still have a 15% probability that you might get beat. And so when you do get beat in poker, and it's on what's called the river card, right? The last card, and people get what's called a bad beat. You had whatever, a very strong hand, and then at the last turn, you lose. People attribute the decision-making process to that outcome as being bad. But probably at every step along the way, you're making good decisions. The result may not necessarily have been, there's still that 15% probability that you might not win. And when that shows up, we attribute things to bad luck. But at the same time, when we do win, we don't recognize that maybe luck had a little bit to play with it too. That there were decisions in there that we made that helped us get to the end and give us an opportunity, if that makes sense, to win. But we also need to have maybe that certain card in poker, or we need that certain thing to occur in our investment. And when that occurs, we think that we were directly connected to that. Okay? So that's the hindsight bias, is we take information and we use it on a go forward basis. And, we can attribute our skills a little bit too much, or we can use the information and project it forward. Like we talked about the last time. Hindsight bias, if something happened in the last 2 to 3 years, we might do it again. Does that make sense?
Absolutely, yeah.
Hindsight shows up in all sorts of different ways.
Yes.
Can't hear you.
Okay.
Your sound's off.
Weird. Oh, my internet.
Oh, there you go.
Yeah, sorry.
There you're back.
I'm back.
We'll just have to edit that part right out that I asked you.
Oh, yeah. Yeah.
Your sound. Okay. All right. So that's hindsight bias, and that's the self-serving bias using Galvin. We got these two little things that are happening. We have to pay attention to what information are we using and how we look back, how things might have appeared to us prior to the event or to the outcome, versus once we get to the outcome, how we can look back and learn from that. Another couple of biases, one to go over, is what's called a framing bias. Okay? A framing bias is when we share the information or we look at the information in different perspectives. Sometimes it's all about how you look at information or how you look at things, right? So here's this cute little cartoon where the dad comes, or the kid comes to the dad. Here we go. And, he's talking about his homework, right? And should I be punished for something which I haven't done? And of course not, right? The dad says, of course not. What happened, right? He says, because I haven't done my homework, right? So a cute little way to illustrate, it's all in how you frame things, right? It's all in how you may ask for things. Now, we take advantage of this in our daily life all the time. Kids get good at it, right? Asking for things in a way that is leading, right? And that's a framing bias in how we frame the information. Right now in our market economy, there's been a lot of data come through that talks about how bad things are. And then we have, for some people, what's called a recovery. And they think, oh, well, we went from a very bad place to a very good place. Well, when you frame the recovery off of the lows, if you say something dropped by 80%, and the number is really low, and then off of a small number, you start to climb back, you start to see these amazing things. Like, we are up 40% on this, or we've recovered 60% of this. So when you lose 80% and then you gain 60%, you're not close to where you were, right? And the easiest way to look at that is if you lose 50% of something, to go back to where you were, you need 100% recovery. So it's asymmetric, it's called. It's that as we drop and as things were bad, you get these big, large numbers off of a large number. If you have that number being 1,000 and you have a 60% drop off of that, right? You have $600 decrease. Now you're sitting at a 400 mark, whether that's dollars or whatever. and you have a $200 increase, right? That's a 50% increase.
Mm-hmm.
So you dropped by 60%, you then increased by 50%, right? But you're still 60% lower or 40% lower. You're at 60% of where you were before.
Yeah.
So news outlets, depending on what they want to get you to focus on, are going to report either that large successive number, like, isn't this exciting? We've gone back up 50% from where we were. Okay.
Mm-hmm.
And that can make people feel really good about themselves or good about the economy. And part of that is what the markets are about, is that psychology, that feeling. I mean, people didn't feel great back in March, and they're feeling a whole lot better now. If you look at the way that things are framed, you pay very close attention to how things are framed, especially when you go into elections and you're dealing with, and I hate to say it, politicians, and how things are being presented to you. You have to kind of take an objective a step back. And this is why when we talked last week, people make emotional decisions, right? You're in the store, you're not going to easily leave and think about what you're doing and then frame it differently. You're there and you've got all these things pulling on you, right? All these emotional feelings. And I want to make that decision now, right? And that is where we get into trouble, is that everywhere we go, people are trying to get us to make those decisions in the moment. And some of these biases, the way that you get out of them is to be reflective, as we talked about, right? Step back, take time, take a look at it differently. Did they frame this in a way, right, that makes you want to do something? Or maybe there's a different way to look at it.
Right. And I think that's not only happening with like the markets right now, but even this entire coronavirus. This is exactly the kind of biases that we're seeing right now.
Yeah, that one's a sensitive one, because I've said that what happens with the COVID is it polarizes us. You
Yes.
find out whether you are a person who's looking at it in this frame, in this perspective, right? So we've got, a lot of information, a lot of data. How we organize that data is really important to having an understanding of what are the risks associated with things, right? And so there is that problem right now in the marketplace, in the news, is what are you using to make as your decision, and what bias might you be being impacted by, right? And framing is a big one with the COVID.
And
right?
the political landscape right now too.
That is very much so. Yeah, this is a big one in how we
it's a big month.
frame what we're looking at.
Yeah.
Yeah, I'm told sometimes that I'm too pessimistic. And I'm like, well, I'm not actually pessimistic. I'm very optimistic, but I'm a realist, right? I understand that there is, this information that's sitting there that I can't definitely be too optimistic that that's going to happen. I have to take that into account, right? A friend of mine once said there's a fine line between optimism and stupidity as well. So, you have to watch what information you're collecting and what you're making a decision on, which leads me to my last one. So our last little example here, I wanted to finish off on because it's the strongest one out there right now. Okay. And that's called the narrative fallacy. Okay. Now, the narrative fallacy is an understanding that we as human beings love a story. Man, movies, a whole of Hollywood exists because of this bias. Okay. We don't necessarily take raw information well. We like to have it connected and have a story told around it. Okay. So in this little example, you got this long lineup for somebody who is providing reassuring fiction. Okay. So it's not good information. It's not real, but it's got a great story to it, right? Makes you feel really good, makes you feel good about yourself, makes you understand. Or, as the person sitting by the desk all by himself, is the inconvenient truth. Okay. Inconvenient truths are all out there. They're very hard to digest. Okay. this to me was the number one thing we dealt with when we had to finally do lockdowns. When you looked at how the COVID spread, all the stories coming out of China and all the news, everybody had a narrative. The politicians, the health ministers, like, it wasn't that they were wrong. It's that they had a story that they wanted to tell to help people understand what was going on. But the reality was there's a lot of math and a lot of data that was coming in that didn't support that. Okay. And that's what happens when you have to change midstream, right? We had to all of a sudden go from, hey, if you go back and watch the news clips, it's not coming here. We're going to be okay. I remember distinctly getting that letter saying there's been only one case in Alberta and not to worry. That's a story, right? A story that we tell ourselves, a narrative that we follow. Now, unfortunately, in investing and in economics and all this in the markets, stories are what sells. Okay. So everybody loves the story of Tesla, how they're going to change the world, right? How fossil fuels are going to go away. Like, all of these are stories and narratives that you can believe in. And sometimes, even if you have all of the data in front of you, you still don't shift your mindset, right? And you can get really entrenched in the stories. So going back in 2019, one of the top politicians I've ever seen that be able to spin a narrative is Donald Trump. So he goes out all the time and uses Twitter, uses the news, and they talked about the great China trade deal and the bean deal, they called it. And they're constantly out there. Every time something happens that's negative, you can watch all of the journalism and all of the media, right, come back up and start to spin positive again. We're trying to keep people positive. The joke I make is that if you've ever seen a disaster movie from Hollywood, the comet's going to hit the earth, the tidal wave's going to wipe everything out, all of that. All these great disaster movies, they have one thing in common, in that the government is always struggling to tell the truth. Like, they're always struggling. Do we tell everybody that the comet is coming? Right? They spin a narrative, and it's an over exaggeration, but it always makes for a great movie, a great disaster movie. But what happens is the same thing: is if you're not prepared and you need people to believe, right? Once you get a certain amount of people believing something, you get what's called herd mentality, which is another bias. If you can get everybody believing in it, the story takes a life of its own. And that, right now, to me, is one of the hardest things going on in our markets today. I've been here before in different times, in 2008, 2009, in 2000, 2001. I've listened to even the ability to tell a story on earnings calls with companies. There's great movies done and great books written afterwards about how people got caught up in the story, in the narrative, and then over time, and they can last decades. This isn't something that can last a couple of weeks. I mean, you can get narratives that we follow, and we're stuck in them for quite some time until we get real information or something occurs to kind of shatter that story base.
And I think social media has just such a great impact on this. And I think it's what's different since, say, 20 years ago, or even the 2008 crisis. Like, this time it's different in some ways because the information is so abundant and all over the place. Like, it's
That's
too
right.
much.
So it leads me, I'll talk quickly, if I can, about one of the things that I think is the most impactful that's under scrutiny right now is the protection of these social media platforms from libel. So in a nutshell, when the internet was first coming out and these companies were first coming out with these social media platforms, they created a bylaw, or not a bylaw, but a law. There was an act that wanted to support and make sure that these companies could get off the ground and things could happen. So they restricted these companies from being held liable for what was posted on their platform, if that makes sense. So you can't sue Facebook right now for somebody posting something like the Flat Earth Society saying, right, Earth is flat. So it's slightly different. They're reevaluating this right now in Congress and in the U.S. There's a lot of rules and laws that we have changed as internet and social media platforms have really sprung up and become very dominant. And it's those kind of things that allows people, because the social media algorithms will find things that will put in front of you that reinforce the bias that you have. Mm-hmm. So the way that you search for things, it isn't objective. Right. You don't maybe realize it, but it's the actual programming in behind constantly showing you a world that you now believe. Right. Now, you're not seeing anything else. They take that away. And so that is that reaffirming narrative, the story that you're telling yourself and you're feeding yourself. These biases are huge. Confirmation bias is a big one. If I continue to get information that reinforces my belief without getting a counterintuitive argument, I'm just going to self-reinforce, if that makes sense.
Right, for sure.
Right? Now, this all started a long time ago, and there was a rule that I talk about that there once was a rule, and a long time ago, 25 years ago or so, that media platforms, not what we consider them today, Facebook and even Apple has become a media platform, but media platforms like people that own newspapers and that kind of media. Remember that? What we had to read and write and print and get the news the next day, not as it's happening.
Yeah.
Okay. There was a rule that said at one time you could not own more than 7 newspapers, 7 radio stations, and 7 TV stations. Okay. And then that changed and it went to 12. They expanded it. Now, the reason for that, there were 2 major rules around this narrative. Where do we get our information? And the reason that rule was there is that you didn't have a huge conglomerate controlling a large market share of information. So that was one of the rules. Like, you could not own more than 7 radio stations, TV stations, and newspapers. So you could not proliferate out there all this information that you may want to. Okay? You were limited in scope. And then there also the license and the rules, the regulation said if you did not share objectively, if you did not share both sides of the argument, if you were biased, you could lose that license. You could be held accountable, and you had to absolutely show both sides. That's what editors and editorials, like, you had people working in the communication industry under media whose job it was is to make sure it was a fair story, right? That it presented both sides, right? Well, that's gone. Those rules have been slowly eroded over time through different administrations. People can now own larger and larger pieces of our communications and our media. And as you said, this social media now in the world today, it's much easier to be polarized, to stay with a narrative, to have confirmation bias, to frame things differently so that we're working on that side of your brain that you don't have control over. And this is why a good education in understanding how these biases work can help people maybe recognize that I'm being affected by this. Right?
Absolutely. Yeah, no, thanks so much, Chris. This was great chat. I really appreciate all the different biases.
This is one of my favorite areas. Yeah. And there's lots of them. This is just, kind of scraping the tip of the iceberg, so to speak. But these are the ones we find most dominant today and most dominant in the investing. There's lots of biases that come in when you go shopping, how commercial marketing works. They know how your brain works. Oh, yes. Pepsi, Coca-Cola figured it out a long time ago, right? So if you look at these kind of things, hopefully this has helped some of your audience here understand what biases are out there. And we can continue talking about some of the things on the next episode. How do we overcome these, right? Maybe some of the solutions versus some of just the problem.
Yes, and this is so important when it comes to our investing and our money in our day-to-day life and trying to help us accomplish those goals without being, stuck in some of these mindsets that really hold us back. So thanks so much, Chris. I really appreciate it.
No problem. It's always a pleasure. It's always fun to chat. And I look forward to our next one.
Yeah, sounds great. Have a good week.